Our new private market SIPP gives you the opportunity to invest in private equity and private markets in your pension. It's the first pension of its kind in the UK. You can invest in private market funds run by some of the world's largest and best respected managers from as little as £10,000. Because you invest through a SIPP, a self-invested personal pension, your investment can grow free of capital gains tax. Plus, if you can and do make new contributions, you could benefit from up to 45% tax relief, meaning £10,000 in your pension could cost you as little as £5,500. You can also transfer funds from your existing pensions, so you don't have to invest any new money. But tax relief aside, why might you want to invest in private equity or private markets in general? The main reason is simple. Nowadays, if you just invest in public listed companies, you risk missing out on a massive slice of the market, and arguably one of the most exciting. Gone are the days when an IPO, that's an initial public offering or stock market flotation, was the ultimate milestone of success. Today's high growth companies are staying private for much longer, delaying or entirely avoiding an IPO. In fact, just 19,000 of the world's 159,000 companies with over $100 million of revenue are listed. All the rest are private, often with no immediate plans to list. So if you just invest in listed shares or funds, you miss out on all these opportunities. And this isn't just theory, it has very concrete, tangible implications for your portfolio. Over the past 25 years, £10,000 in private equity could have delivered nearly £100,000 more than the same amount invested in global equities, outperforming on average 6.2% a year net of fees. Though of course past performance isn't a guide to the future. But it's no surprise some of the world's largest investors, whether pension funds, institutions, sovereign wealth funds and the ultra-wealthy, have been allocating in the region of 20 to 30% of their portfolio to private equity and other private market investments. Private investors, however, have largely been unable to do so. But this is finally changing. Now, not only can you get exposure to private markets from a relatively small investment of £10,000, you can also combine that with valuable tax breaks of a pension. So should everyone rush in and invest? No, beforehand investors should make sure they fully understand the risks. As with any investment, returns are not guaranteed. Your investments can go up as well as down in value. In addition, private equity investments are more risky and illiquid than your ordinary listed shares and funds. They often use more complex strategies and can be harder to price and value. What's more, there are restrictions around redemptions, and you should think of these as long-term investments. This is why even just to be able to see the details of the funds on our website, we ask you to confirm you are a high net worth or sophisticated investor. To invest, you'll need to become an elective professional client of Wealth Club and answer a few more questions about your investment experience. That said, if you are experienced and are comfortable with the risks, it could be worth looking into private market investments to see if they're right for you, rather than missing out on this asset class and the potential opportunities altogether. It's also worth remembering that private market investments can also offer a great deal of diversification to your portfolio. There's plenty more information on all the funds available through Wealth Club on our website.